listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. With me today is a returning guest, one of my favorites because, you know, he's I don't want to say he's a gold bug, but you guys know I like to stay away from the typical gold bug point of view, even though, I always admit I am a gold bug. Brent Johnson, CEO of Santiago Capital, is with us. And, I always like to point out when I interview Brent, he's one of the only people in the last 5 or 6 years or so who was bullish on the dollar, bullish on the stock market, and bullish on gold. And so one of the only people who got all those things right in that time period. Brent, thanks so much for coming on. I'm trying to think of a non-big picture question for you, but it's kind of tough. I'm looking at the chart of the dollar, the technicals. The dollar had this big move up. Then it had this decline, and it's been rebounding. And, after last week, a lot of people are saying it's breaking down. But I'm looking at a chart, and I see, look, this is above the 200-day moving average. 200-day moving average is sloping higher. This looks to me like it's in an uptrend. So starting off here, I just want to get your view of your view of the current trend in the dollar. Do you think it's still in a bull market? Is it going sideways? Is something changing? I know that's a lot to take in for a first question, but please share your views.
Yeah, sure. So I'll get into that. Before I do that, I'll just say thanks for having me back. I always enjoy talking to you. And I don't mind I actually am a gold bug. At heart, I am a gold bug. And I know you are too. And I know the reasons why you don't like necessarily being labeled one, because I don't like it for the same reasons. But the truth is I am a gold bug. But I try to see the world as it is, as opposed to the way I would like it to be. And while I'm confident that gold is going to go much higher in the years ahead, I just don't think that every time it moves up $5 that this is the sign of the apocalypse and the dollar is now going to die. So that's probably the best little introduction for how I view myself. But as far as the dollar itself, I found it a little bit amusing last week when people started all of a sudden being bearish the dollar again, because it had literally gone up for 12 weeks in a row or something. I think it bottomed. It had the really big run last year. And then at the end of last year, when rate hike expectations started to fall, and even though they were still going to hike, they weren't going to hike at the same speed. Markets trade on expectations. And at the same time, they were expecting that the ECB was going to continue to hike, and they were saying the Bank of Japan might start hiking. And so on a relative basis, the expectations for rate hikes abroad were greater than they were in the US. And as a result, the dollar had a very big pullback from, I think it was like 114 to 100 into July. And then from July, literally until maybe a couple of weeks ago, I think it went up every week. And so it had a huge run. And anytime you get a run like that, I don't care whether it's dollars, gold, stocks, soybeans, or whatever it is, nothing moves in a straight line forever, and you're going to have pullbacks. And so I'm not really surprised at the pullback in the dollar. I'm actually surprised it went as long as it did without a pullback. But I think that we are still probably in a bull market. And I think that the dollar goes not only higher, but I think it goes significantly higher. And the reason I think that it's not really based on it's not really based on technicals. It's not based on any specific thing other than the fact that I think we have too much debt in the world, and we have too much dollar debt in the world. And I think that has consequences. And the reason it has consequences is because most of that debt is owed in dollars. Most people know that the United States owes 30 trillion or 32 trillion or 33 trillion, whatever the number is now, in US dollars. But what most people don't know is that the rest of the world also owes about that same amount in US dollars. So there's an incredible amount of demand for dollars just to service and pay back that debt. And if they decide to default on it, the rest of the world doesn't owe that money to the United States. They owe it to each other. And so if they decide to default on that debt, they're going to be hurting themselves and those defaults would actually decrease the supply of dollars. And then you get into a squeeze where the dollar goes even higher. And I just think we're in a situation now where the central banks, the monetary authorities, the governments of the world, they can kick the can down the road a little bit, but I don't think they can kick it down the road for years. And so there'll be little periods of time where the dollar falls. But I think in general, it's in an uptrend. And I think as it moves higher, it's going to cause problems for much of the global economy. So that was probably a very, very long way of answering your question, but I hope that lays it out fairly smoothly.
Yes. Okay. So dollar still in an uptrend, still in a bull market. So, I mean, let's presume that the dollar continues to push higher here at some point, gets closer to that 2022 high, just around 114 on the Dixie. How do you think that impacts the other asset classes?
Well, I think initially it's probably a headwind, right? It doesn't mean that gold and dollar can't rise together. And in fact, I think if we're not in that scenario where they both rise together yet, I think we're getting pretty close. And the reason I say that is that gold held up very well all year, despite the fact that real yields were rising. So I kind of believe that gold trades on real yields, meaning the rate of interest minus the rate of inflation. And when that's negative, I think that is extremely good for gold. And when it's positive, that's at least a slight headwind for gold. And real rates were rising this year, and yet gold held up very well. It held up very well until the September Fed meeting, when they were unexpectedly hawkish. They withdrew a couple of the rate cuts that were previously expected, and that's when the longer term bonds yield started rising. And as those started rising, then real yields rose with it, and gold had a pretty hard pullback. Let's just call it September, October timeframe. The 3 weeks after the Fed meeting. And I thought that gold was around, I don't know, 1820, something like that. And I was actually ready to buy some because I thought we were very close to having just a really nice, just complete washout and everything. And then the events in the Middle East happened. I think that was October 7th or 8th or something like that. And, gold very quickly recovered that $100 or $150 it had lost in the previous 3 weeks. And I was a little frustrated because, again, I thought gold was very close to making a really good bottom. And I kind of feel like that the events in the Middle East I think it brought a lot of weak hands into gold and silver, unfortunately. And I've been doing this for about 25 years, and I've never seen precious metals move higher on a geopolitical instability or war, or however you want to describe what's going on, that it didn't give it all back within a month or two. So in the very short term, I think gold probably pulls back a little bit. But having said that, I think gold has done very well this year, and I think gold will do pretty well in the years ahead. So I don't really consider myself a gold bear. We own gold in our portfolios. We think everybody should own gold. But I don't chase gold on moves like what we saw over the last couple of weeks, and I tend to wait for a pullback after that before adding.
Yeah, just a quicker question. How much of a geopolitical or war premium do you think is in the price right now? Could it be $100 an ounce, $50 an ounce, 30? Any idea?
I think it's about $100. I'm not saying the entire move, because I think we were around these levels. We fell to like 1820, and then we came back to these levels immediately. Now, I don't necessarily think the entire move back to these levels was geopolitically motivated, but I think a lot of it was. And, I think, you got to remember, I think a lot of people in let's call it the gold bug community, go out and they buy coins or whatever it is, and they just stack them away and just wait. But a lot of the big players trade in futures, and futures have inherent leverage in them. And when it starts going against you, and when it starts going against the speculators, and a lot of specs if you look at the commitment of traders, a lot of specs came back into the market during that geopolitical upswing, let's call it, and not a tremendous amount, but a lot did come back in. And when you trade on leverage, it's harder to hold on when you get these pullbacks. And we've had maybe a $30 or $40 pullback from the recent high. And if it goes another 10 or 20 bucks lower, I think we could get kind of a snap fall back to 1850 level or something like that to kind of clear out those recently added specs. But again, if you own gold as kind of a piece of a strategic piece of a diversified portfolio, I'm not saying that everybody should go out and sell their gold. I'm just saying I don't expect it to pay off right away. And I think if you're looking to buy some, you're going to get a chance to buy it a little bit lower than here.
Okay. It's always not necessarily a great idea to think about the reasoning why a market could make a move or break out. But I'm just curious because you have, again, you think differently, and I like that. What is going to get gold to finally break above 2050 or 2100 here? Because it's gotten really close, and it's still really close. Even if it drops another 50 or 100 bucks. I mean, in your worldview, how do you see a breakout in gold playing out, and what could be the driver if there's an obvious one?
Well, I think it would be a combination of a couple things. First, I would say that I think it is just as likely that gold breaks through that level and moves higher based on events outside the United States than based on events inside the United States. If you look at gold in other currencies, whether it's yen or euro or pound or yuan or reals, whatever it is, gold has done very well. And it's at all-time highs or very close to all-time highs in a number of global currencies. It's really only the dollar that it's not at its all-time high. And even in the dollar, it's only $100, $150 away from its all-time high. So it's not like we're dramatically below the all-time high in dollar. And so I feel like it is kind of a global market. And if we get into a situation where countries outside the United States, which are currently having a much bigger problem with their own currencies than the U.S. is having with the dollar, if demand were to really spike from those countries, I think we could get into a situation where you could see dollar and gold rising together. Because I think even in that scenario, you'd probably even get some, U.S. buyers buying gold. And I think if the dollar was spiking, that would probably be a bigger headwind. But if the dollar is just kind of drifting up slowly while there's crisis abroad, I think you could see, I think that could push it through the all-time high. The other thing it would be is if we have some kind of a crisis that then warrants a return to easy monetary policies. And again, I'm not just talking about the Fed here. I believe we probably will get into some kind of a market where they have to, even if they're not doing full QE, they'll have to stop with the tightening of monetary policy. And I think when that happens in you get global liquidity coming in from central banks and monetary authorities again, I would think it would be hard to keep gold under 2100 or 2200 in that type of an environment. So either of those two things, or maybe a combination of the two things, I think would probably do it. This is a long way of saying that if we do get back to the 1800 level or something like that in gold, I think that would be a great time to load up and buy, because I do think we're going to go much higher. I have a hard time sitting here thinking 2 years from now that we're not above that all-time high and probably higher than that. Never say never, and I always reserve the right to change my mind. But when I just sit here and look at the world, I think that that's probably unlikely.
Yeah. So you've been alluding to this, and I don't want to pin you down to make a definitive statement. So in this scenario, gold breaks out. There's a measured upside target of around 3,000. So presuming that happens, do you think that move is going to be the point when gold and the dollar go up together? I know I'm like asking you to repeat yourself, but I just kind of want some clarity on your views. I mean, do you think the odds?
I think so. I don't necessarily think we're there yet, but I think we're getting pretty close. And the reason I say that is the scenario, you kind of got to understand how this can even happen in the first place. The scenario where gold and dollars rise together is probably a scenario very similar to what we had after COVID, where all global central banks are providing liquidity or stimulus or bailouts, however you want to define it. Globally, fiat currency is getting debased. It's just that on a relative basis, the dollar is getting debased less than the other currencies. So you have the dollar rises versus all other currencies, but then you have gold rising versus the dollar and rising versus all other currencies. So if you look at all the currencies and gold and dollar, you would have, on the left, all of them lower would be all the other currencies. And then on the right, the two tallest ones would be the dollar and gold. And that is, so this is a way of saying that you can have a debasement of currency and you can have an inflationary environment where the dollar is rising versus its other fiat peers. And I think ultimately we'll get into that situation. The reason I say ultimately is because I've always said that based on the design of our system, it's always going to be prone to negative deflationary shocks. And, there'll be terrifying drawdowns along the way. We saw that in 2018, we saw it in 2019, we saw it in 2020, we saw it in 2022. So despite the fact that gold, dollar, and equities are all higher than they were 5 years ago, it's not like it was a smooth ride. There were some dramatic drawdowns along the way, and I can't rule out those taking place from time to time. So, but I do think that the next time we have a really bad drawdown, I think it's very likely that we do get another policy response similar to what we had after COVID. And I think that's probably the environment where you get gold going higher. The one thing that I think is different, not one thing, there's probably several things. But while I don't think it'll be exactly the same as after 2022, or I'm sorry, after 2020 and COVID, is because the world is no longer cooperating the way they used to, back 3 years ago. Now we have significant geopolitical tensions, not just between U.S. and China, but U.S. and Russia, U.S. and the BRICS and the rest of the world. You've got Middle Eastern turmoil, Israel versus much of the Arab world. And so I think it's very hard to have a unified, coordinated, cooperative response to a global deflationary shock the same way that we had 3 years ago. Not only that, but if you remember back to 2020, one of the things that helped stop the crisis, or at least slow it down in nominal terms, was the Fed opened swap lines and provided US dollar liquidity to the rest of the world. I think that is likely to happen again, but I think whereas last time it was just kind of unlimited, I think this time it will come with many strings attached. And I don't think certain players will get access to that liquidity the same way that they did last time. And I think the US will use it more judiciously and perhaps even use it as a weapon, if that's the right way to say it. And as a result, I don't think it's necessarily just a full-fledged smooth ride higher like we had from March 2020 to the end of 2021. And so I think people need to be ready for the debasement of currencies, but I don't think it's a situation where you can just buy gold and other commodities, sit back and ride easy. I think it's going to be very challenging over the next 2 or 3 years.
And last thing, can you touch on the bond market? In your view, if there's a new secular bear market in bonds, is that also driving gold, or does that not factor much into your bullish view?
Well, it's a bit of a double-edged sword. I think it's important to understand that while the U.S. debt and the budget deficit are bad things long-term for the dollar and good for good for gold, in the very short term, those things can be good for the dollar and bad for gold. And I'll explain what I mean by that. Again, we talked earlier about real yields rising and real yields being negative for the price of gold. As I think because of the budget deficit, because I think it's going to be very big next year, and I think it's probably going to be bigger than many people expect now, especially if we have this geopolitical conflict going on. That's the U.S. government, which is the biggest entity in the world, the biggest buyer of dollars in the world, right? They're going to be issuing bonds, and in exchange for bonds, they want dollars from the global market. So they're going to be taking dollars from the market. Now they're going to turn around and spend it right back into the market. So it's a little bit circular, but that is a demand for dollars. And I think that has the potential to push the price of dollars higher. That could be a headwind. And again, as the government has to spend more money and run a bigger budget deficit, that's also going to make, and the debt just continues to skyrocket. That's going to make people who buy the debt want to get a higher yield. Now, I don't think that we're going to have a situation where treasuries aren't sold and there's a boycott of U.S. treasuries, but that doesn't mean that they won't want a higher yield in order to buy them. So it wouldn't surprise me at all to see the 10-year go to 6% or 7% sometime over the next year or two. And that's if we don't have a crisis. If we have a crisis, I would expect yields to come down. But if we move in the next year without a crisis and the government is still spending the amount of money that they're spending now, I would expect yields to go higher. And, as yields go higher, then that makes real yields go higher as well. And that is a headwind for gold. So, but it doesn't mean that gold crashes. It doesn't mean that gold goes back to $1,000. It just means it's a headwind. So, and again, as interest rates go higher in the U.S., that makes it more attractive to hold dollars than hold another currency. If you let's say you live in Brazil or Australia or wherever it is, and you can put your money in 2-month T-bills and get 5.5%, and the dollar appreciates versus the Aussie dollar, that's a pretty good return for holding very short-term money. So that makes the dollar attractive to foreign owners. And, that has the potential to then cause people to move money from other markets, emerging markets, into the U.S., into the U.S. dollar. And so higher rates have the tendency to push the dollar higher because there's demand for those for that type of a return. And so I think it's important to kind of keep all that in mind. Now, in the long run, this is really bad because debt's unsustainable, all this kind of stuff, right? But in the short term, you got to understand how it can have the opposite effect. And I think that could be a headwind for gold. And that's why I've said I don't think we're necessarily gold and dollars rising together yet, but I do think we're getting very close.
Well, on that note, we got to leave it there, Brent. But thanks so much for coming on. Really appreciate it. Always thought-provoking views. And if our listeners would like to follow you on Twitter or learn more about the work you do, could you tell them how they can?
Sure. As you know, I'm pretty active on Twitter. My handle is @Santiago AU Fund, or you can just type in Santiago Capital, and my logo is a white seashell, so it's pretty easy to find. I have my own podcast that I do with a friend of mine once a week. It's called Milkshakes, Markets, and Madness. You can find that on YouTube. You can also go to @MilkshakesPod on Twitter and find all the links and stuff there. So I appreciate you having me on. I always enjoy talking to you, and happy to do it again at some point.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.